Hey everyone, and welcome to another deep dive. Today we're focusing on something near and dear to a lot of you out there, the stock market.
Definitely a hot topic.
And we're going deep on the closing market report from Market Deep Dive. It came out just yesterday, October 25th. One of the things that really jumped out at me is this kind of push and pull between rising yields and some pretty impressive tech strength.
Yeah, it's an interesting time for sure. You see the S&P 500 and Dow Jones both ending the week in the red, and you might think, oh, is this a sign of things to come?
Right.
But then the Nasdaq hits a new intraday high.
Wow.
So it's clear there are some forces at play here.
So it sounds like tech is kind of defying the odds.
Mm-hmm.
And the report points to investor confidence in certain sectors.
Right.
What's driving all that optimism?
Well, it really comes down to innovation and the potential for growth. Companies like Tesla and General Motors, Texas Instruments, ServiceNow, Lam Research, they all had really strong earnings this week. So that's signaling that even with all the economic uncertainty out there, investors are still really excited about certain areas of the tech world.
Yeah, okay, so that's good news if you're holding on to some of those tech stocks.
Yeah.
But the report also mentions rising yields on the 10-year Treasury note.
Mm-hmm.
And it sounds like that's making some people think twice about buying stocks. In fact, they even suggest that we could be in for a pretty volatile week.
Potentially, yeah.
So break it down for us. Why does this matter to the average investor?
Well, think of it this way. When yields go up, bonds start to look more appealing.
Okay.
They offer better returns for the risk, so it's almost like a seesaw. Right now, bonds are gaining some weight, and that means money could start flowing out of stocks and into those bonds, especially in sectors that are sensitive to these interest rate changes.
So some parts of the market are going to feel this more than others.
Exactly, and we're already seeing that happening in sectors like industrials, materials, healthcare, and utilities. These are sectors that are often seen as stable investments, but they can be more vulnerable when those yields start rising.
And so investors are starting to look at bonds with their steady returns and thinking maybe that's a safer bet right now.
Yeah, it's a natural reaction to uncertainty.
Makes sense. All right, let's dig into some specific company stories because this report has some real cliffhangers. First up, there's the drama unfolding with Tapestry. That's the company behind Coach and Kate Spade. And Capri Holdings, which owns Versace and Michael Kors. What went down there?
This is a textbook example of how antitrust concerns can really shake things up. Tapestry was all set to buy Capri, big merger, lots of buzz, but a judge ended up siding with the Federal Trade Commission, basically putting the brakes on the whole deal.
Wow.
So Tapestry's stock price shot up over 13%, while Capri took a nosedive almost 49%.
Whoa. So huge win for Tapestry. But what's the lesson here for everyday investors like me?
I think it really highlights how unpredictable mergers and acquisitions can be. There can be regulatory hurdles, unexpected outcomes, and the impact on those stock prices can be massive.
Yeah.
It's a good reminder that diversification is key.
Don't put all your eggs in one basket.
Exactly. And don't get too caught up in all the hype around potential mergers.
Sound advice. Now, on a more positive note, the report also shines a light on Western Digital. Seems like they're riding the cloud computing wave pretty successfully.
They are.
Their stock jumped over 4% this week, and they've got some really positive guidance for the future.
Yeah, they're definitely one to watch. Western Digital is really showing how important it is to adapt to the changing tech landscape. Cloud services are in high demand.
Sure.
And their strong performance, plus their optimistic outlook, it all suggests they're in a great position to capitalize on this trend.
Now, not every company is having such a stellar week. HCA Healthcare, for example, saw their stock drop almost 9%. They missed those earnings estimates. And of course, those recent hurricanes haven't helped either.
No, not at all. This really underscores how those unexpected events, whether it's a natural disaster or a sudden shift in consumer behavior, can directly impact a company's bottom line and ultimately their stock price.
Yeah.
It's a reminder that even in a seemingly stable sector like healthcare, there are always risks to consider.
Absolutely. All right, let's zoom out a little and talk about earnings season as a whole. It's been a pretty mixed bag so far, hasn't it?
Yeah, it has, for sure. Some companies are really knocking it out of the park, while others are, falling a little short. Overall, Q3 earnings growth is looking to be the weakest we've seen since the middle of 2023. But here's the thing. The market doesn't always react to the actual numbers themselves. A lot of times it's more about whether a company meets or exceeds those expectations that analysts set.
So it's all about managing expectations.
Exactly. A company could have decent earnings, but if it falls short of what those analysts predicted, their stock could take a hit. And on the flip side, a company might not have amazing numbers, but if they beat those forecasts, investors might reward them.
Makes sense. So who's coming out on top this earnings season? Who are the winners and losers so far?
Well, on the winning side, we've got companies like American Airlines, UPS, Southwest Airlines, and Lam Research. They've all put up some pretty impressive numbers. And on the other end of the spectrum, IBM, Newmont, that's a mining company, and Boeing, they haven't fared so well. Their results came in below expectations.
Got it. The report also mentions this data from FactSet that shows that while 75% of S&P 500 companies have actually beaten those EPS estimates, it's still below the historical average. So what does that tell us about the rest of earnings season? Is that a cause for concern?
It could be a bit of a yellow flag, yeah. It suggests that maybe the overall earnings picture isn't quite as rosy as some people might have hoped. But we'll have to see how things play out over the next few weeks, see if this trend continues or if we get some positive surprises.
Speaking of things to keep an eye on, next week is going to be a big one.
Oh, yeah.
We've got a bunch of those mega cap tech companies reporting earnings. Alphabet, Microsoft, Amazon, Meta, Apple, they're all going to be releasing their results.
It's going to be a huge week for the markets, no doubt. And, tech has been performing pretty well lately, so these earnings reports could really set the tone for what's to come. I think a lot of investors are going to be watching very closely to see if these giants can keep up that momentum.
And it's not just about company earnings next week, right?
Yeah.
We've also got some important economic data coming out. The report specifically calls out the PCE price index, which gives us that read on inflation, and of course the non-farm payrolls report. Both of those are coming out next week.
Yeah, those are key indicators that that's the Federal Reserve, the folks who set those interest rates, they're going to be watching those very carefully.
Right.
The PCE tells us how prices are changing for consumers, which has a huge impact on how the Fed thinks about inflation. And the non-farm payrolls report gives us insight into the strength of the job market.
Right, so it's kind of a big deal.
It is a big deal. It's another crucial piece of that economic puzzle.
So with all this happening next week, what does it all mean for the average investor?
Yeah.
Someone who's just trying to make sense of what's going on in the market.
Well, I think it's safe to say that a lot of people are feeling a little uncertain right now, and that's understandable. The market is sending us some mixed signals. We've got tech seemingly defying gravity, but then we've got concerns about those rising yields and the possibility of a slowing economy.
It's a lot to take in, for sure.
It is. The report even talks about how market breadth has narrowed recently.
Now, I know that sounds like a bunch of jargon.
It does.
But explain it to us like we're five. What does that really mean?
Sure. So basically it means that fewer stocks in the S&P 500 are trading above their 200-day moving average. Now, that average is a pretty key technical indicator that a lot of investors use to gauge the overall health of the market. And when fewer stocks are trading above that average, it can be a sign that the rally might be losing a bit of steam. It doesn't necessarily mean a crash is imminent, but it does suggest that some investors are starting to get a little bit cautious.
I see. And the report also mentions an uptick in volatility. The VIX, that fear gauge for the market.
Yeah.
It's been climbing lately. So what does that mean for those of us who aren't day traders glued to our screens all day?
Well, volatility, those ups and downs in the market, is something we all have to deal with. It's especially pronounced during times like these when we're heading into an election and waiting on big economic news. The key is not to panic.
Easier said than done sometimes.
I know, but it's important to remember that those short-term fluctuations are often driven by sentiment and rumors. The best thing you can do is focus on your long-term investment goals and don't let your emotions dictate your decisions.
Stay calm and carry on.
Exactly. Have a plan and stick to it.
Speaking of plans, the report mentions that the market seems pretty convinced the Fed will cut interest rates soon.
Yeah, and that's been the expectation for a while now.
But the report also says that the expected size of those cuts has actually decreased compared to what people were predicting a few weeks ago.
That's right.
So does that mean the Fed is getting less dovish, less likely to cut those rates aggressively?
It's hard to say for sure. They base their decisions on a whole bunch of factors, things like inflation, employment, overall economic growth. It's a complex equation. And that's why next week's economic data is going to be so important. It'll give us a much clearer picture of where the economy is headed, and that could definitely influence the Fed's next move.
Right. And the report does highlight some positive economic news, too. Things like strong consumer sentiment numbers, healthy, durable goods orders, which suggest people are still spending.
Yeah, for sure. Those are definitely encouraging signs. Strong consumer spending is crucial for economic growth. But the report also notes that the Atlanta Fed's GDP Now estimate, which is basically a real-time tracker of GDP growth, that's edged lower.
Oh, interesting.
It's still predicting decent growth, but it does suggest that things might be slowing down a bit.
So it's kind of a mixed bag right now. We've got some conflicting signals coming from different parts of the economy.
Yeah, that's the nature of the market. It's constantly evolving, constantly reacting to new information. And our job as investors is to stay informed, try to make sense of that data, and ultimately make decisions that align with our own individual goals and our risk tolerance.
So as we start to wrap up our deep dive into this closing market report, is
Mhm.
there anything else that really stands out to you from all this?
It's fascinating how some individual companies can kind of buck the broader trends.
Right, like Tesla this week. Their stock price jumped massively, even with everything else being kind of jittery.
Yeah, exactly. Their earnings were strong, their outlook is positive, and that really caught the eye of investors. It shows that doing your own research, really digging into individual companies, can pay off, even when the market's a little uncertain.
Definitely. The report also pointed out some big moves in the financial sector. Capital One, for example, they rallied on strong earnings. Does that tell us anything about the bigger picture? About the consumer, maybe?
Right. The financial sector often acts like a mirror, reflecting the health of the overall economy. So Capital One's performance, I think, suggests that people are still spending and borrowing, which is a good sign.
Okay, good news there. But we can't forget healthcare. The report mentioned that it's been lagging behind this week. HCA healthcare especially took a hit. What's going on in that sector?
Yeah, healthcare can be a bit tricky. It's really sensitive to changes in interest rates and, government regulations can shake things up. Staying informed is crucial there. Really got to do your homework.
So let's look back at everything we've talked about today. What are some key takeaways for our listeners, those trying to navigate this kind of market environment?
I think the first thing is to remember that diversification is your best friend. Don't put all your eggs in one basket. We saw how different sectors are reacting to all these forces. Spreading your investments can really help manage that risk.
Don't put all your eggs in one basket. Classic advice, but true.
Absolutely. And second, stay informed. Keep reading reports like the one we've been talking about. Follow the news. Do your own research. Knowledge is power when it comes to investing.
Right. And to add to that, don't get caught up in all the day-to-day ups and downs. Remember those long-term goals.
Couldn't agree more. Investing is a marathon, not a sprint. Stick to your plan, rebalance if you need to, and just ride out those short-term fluctuations.
Great advice. So as we wrap up this deep dive, I think it's important to remember that understanding the market isn't just about the numbers, right? It's about understanding all the forces that shape the world around us. And that's what we've tried to do today.
Exactly. By really digging into this report, we've gained some valuable insights into those trends, the challenges, the opportunities that are shaping the market right now.
Absolutely. Well, thanks for joining us today, everyone.